conversation on Business Redefined. We want to talk about matters banking and the outlook for 2023, and we're delighted to have the chairperson of the Kenya Bankers Association, as well as the Group MD, NCBA Group. Karibu sana, John.
Thank you, Julius. Good to be here.
So, John, let's start from here. I was doing an analysis of the Q3 numbers for the banking sector, and you can clearly see that the bottom line was significantly propelled by the foreign exchange trading income. And whereas that is good for the banks, especially for the non-funded side, the question comes in, when this tide recedes, are banks ready for it?
Yeah, so you're right. If you look at the results that we announced in Q3, across all the banks, we had very good performance in foreign exchange. Obviously, driven by the scarcity of the dollar and therefore enhanced margin. But what we are seeing is two things. One, the demand for dollars is very, very high. And we don't see that reversing anytime soon, because commodity prices all over the world are high. And with what's going on elsewhere, where rates are elevated, interest rates are elevated, the war in Russia and Ukraine, what's happening in China with the COVID issues there, we do think that commodity prices will stay high for quite some time. That means the demand for the greenback will continue for quite some time. So I think what will happen, however, is that the supply of dollars, that is going to increase, obviously from the tea sales, the horticulture sector, our coffee sector, our tourism sector. We do expect that, the pressure on the dollar will start to go down, but I believe the volumes will stay quite high. So whereas we shall see some reversal, I don't believe it will revert back to the volumes that we have seen prior to COVID. So that's one. I think the second thing is that any good banker knows that when you make hay when the sun is shining. And I believe that every bank is trying to do other things to capitalize on the fact that they're able to give dollars during this time and perhaps convert those customers into long-term customers so that they will increase maybe their lending book as a result of their customers they have been providing FX to, and also come up with some other creative products. At least that's what NCB is doing.
I see. And you've spoken about potentially seeing thawing out of the tightness we've seen in the FX market. And there's been so much conversation around the state of the interbank foreign exchange market. If you could just comment on the state as it is right now, because there's been the sentiment that it is dislocated. Yeah.
So I think there has been very strong sentiment about why the interbank is not working. The reality is the interbank is the golden pricing of the dollars, yeah? And I think that's what we call the official rate. The problem is today I have a very huge customer book who are waiting to be supplied with dollars. I have no extra dollars to sell to my counterparts in the other bank, and I'm sure they have the same problem, where the demand book for their own customers is quite high. And therefore, they don't have dollars to sell to me, to sell to my customers. So until such a time that the supply of dollars stabilizes, until such a time that the demand book is met, it's going to be very difficult to have an interbank market. As I keep asking my colleagues, yes, it's true that it has been dislocated, but if you had dollars, even if the pricing was right, would you give it to me or first serve your customers? And the answer is always, I'll first serve my customers. But I think that said, obviously over time, as supply of dollars increases, as hopefully some of the demand eases, the oil price hopefully eases. Yeah. Once that demand eases, what will happen is that banks will have some dollars that they can sell to each other. And therefore, we'll see the rebirth of interbank. And also, the closing of the gap between what we call the interbank rate or the official rate and what you see, the negotiated rate, which is the counter rate, because those two are quite different today.
Okay. And is the KBA making any interventions within the banking sector towards addressing this, maybe?
Yes, we are in constant conversations with our regulator. Everybody understands that it's important for the interbank to work. Everybody also recognizes where we find ourselves in and why it's not working. It's not just the pricing, and I think that is a mistake people make. They just think once you get the pricing, if you just raise the price, official price to whatever the negotiated price is, that we'll have interbank working. The reality, and I've explained this before, is that we always had two different rates. We always had the official rate, which is the interbank rate, and we always had the counter rate, which is negotiated. Yeah, I mean that is why we all post our rates. Otherwise, we just have one rate. Yeah, that's why banks post different rates, because those are the negotiated rates. And even those, when you walk in to sell dollars or to buy dollars, you'll be offered maybe a rate where you negotiate. If you're buying a lot of dollars, you may be offered a very different rate than a retail customer who comes to sell $1,000. So rates are negotiated over the counter quite a bit. What has happened in the previously, the difference between the official rate and the counter rate was quite thin. Yeah? And therefore, because the demand for dollars was not that high, therefore you find banks that had excess dollars will then sell to another bank that needs the dollars. As I said, what has happened today is that every bank needs dollars for its customers. Therefore, the interbank rate cannot really work, even if the pricing got very thin. The pricing will get thin when the supply of dollars is sufficient. And then you see the return of the interbank rate. Because we all understand that, we're in constant conversation with our regulator. We have always said that the interbank does need to work, but we also all understand that the interbank only works when the supply of dollars is quite uniform and available.
Okay. Let's look at some of the major regulatory developments which happened late 2022, the first being the credit repair framework and the intervention whereby half of a loan book is actually being forgiven for digital credit. And I can't think of a tier one lender more exposed, if I could say, than NCBA. Could you just care to give us some flavor around how this is panning out for you?
Yes, so just to clarify, the credit repair mechanism applied to digital loans that are 30 days or less. So I think it's important to clarify that. So for us, that will touch on Mshwari and Fuliza. Yeah? And therefore, you find that for M-Pesa, KCB M-Pesa, they will be affected, and a few other banks that do those short-term loans, and those short-term digital loans. The second thing that's important to note is that the credit repair mechanism applied to what is called the written-off book. Yeah, so it's a book that has been non-performing, and for the most part, that has been written off from our books. You don't see it on our balance sheet. Yeah, so that means any money we get, we are able to recover from that book is a credit, it's a positive. Yeah, and therefore, I saw some of the discussions being how much loss banks will incur because of this. The reality is we have taken that loss already. So it will not show up on our books. What will show up on our books is positive. It's what we can recover. We supported it very much, working with the regulator, because we believe that is important, one, that we give these Kenyans, millions of Kenyans, a chance again. And so the decision immediately was to reinstate them onto the positive book of credit, or positive reporting, and give them 6 months to repair that credit. Different banks and different organizations took different paths. So even though it was said that you will forgive at least 50%, for example, NCBA went out forgiving 70%. Yeah, so we're forgiving 70% for a period of time, and that will move to 50%. So the early the early believers will get very good forgiveness. Obviously, the later ones will get the 50%. And we believe the idea is to incentivize these customers, these Kenyans, to get back on track on the positive credit track. So I just wanted to say that. So for NCBA, therefore, yes, we are perhaps the most exposed in that digital credit, 30-day credit, given our play in Mshwari and, of course, Fuliza. We welcome this very much because these are customers we've been trying to collect from anyway. So any sharing we can collect from them is a positive.
I see. Interesting take there. And now that you've touched on Fuliza, we saw the slashing of the tariffs, and maybe just give us some thoughts around how that is going ever since, and how do you expect it to reflect in your numbers?
Yes.
Yeah.
So, as you recall, in September, we cut pricing on Fuliza quite drastically. I think on the lower band, we have done 50%, and plus 3-day free, almost 3-day free, interest free. It was a decision that had long in coming, in the sense that we had observed over time, and I think I described this, the COVID phenomenon. Fleaser was supposed to be an overdraft, supposed to help you complete a transaction, and in our mind, when we created it, it was at most going to be a 3-day credit. Why? Because most people would go to buy something, they realize they don't have enough money on M-Pesa, they go back, and in 2 days they come back and buy because now they have loaded up their M-Pesa. That is the gap we're trying to create. During COVID, what we noticed is that the average Fleaser loan went from being 3 to 7 days to being 14 to 27 days. So it was staying a lot longer. And we realized people started using it as long-term credit. Which we have in Mshwari. And so our thoughts had been, what do we need to do to bring people back to using Fleaser for what it was intended for? So the changes that we made, the cut-in pricing, was first of all because obviously we had heard the cries of the public that was too expensive. But the other change, which was more significant, is making it free for 3 days. When you make it free for 3 days, we're encouraging customers to go back to what we had observed before, which is within 3 days, load back and get a new loan if you need to. But do not use this as a long-term credit. If you need that, there are options, like I'm sure, that are available. In terms of the performance, as we expected, we have seen much better churn. People are using it a lot more, so they are paying a lot sooner. We've seen volumes have gone up significantly. We are up about 14% in terms of volume since that time when we made that change. So it's been a positive change. It's been received well.
So it's more like volumes of a margins trade-off.
Exactly. Volume of margin trade-off. You got it.
I see. Another major regulatory change, but this has been rolling over time, is the discussion around risk-based pricing. And I know you and I have sat down before and you said, first, there is nothing like there's an absence of risk-based pricing in this market. But now that we've seen a number of banks coming forth and saying we've received approval, as a banking sector, do you see the risk posturing changing as we get into this?
Well, I think it depends on how it's explained to their customers. For me, I look at risk-based pricing to be only effective if there is a clear understanding of the customer's mind how that risk-based pricing affects them and how they can change their own risk rating. And I think that's the journey that we have started on. Yeah? Explain to the customer that if you have better CRB rating, that helps your credit scores. If you borrowed a bit more, that helps your credit scores. If you make sure you pay all your debts on time, that helps your credit scores. Yeah? And what kind of loans also affect your credit score? The type also affects your credit score. And I think once you do that explanation, then customers then take matters into their hand. Because that was the idea. The idea was to give customers the power to manage their pricing. Yeah? And therefore, that explanation becomes very important. So I can see that changing fundamentally if banks do that education. And I'm urging my fellow bankers to ensure that we educate our customers on how their own behavior affects their pricing.
In its first meeting, the first Central Bank Monetary Policy Committee meeting of this year, yes, the CBK has indicated that asset quality is on an improvement trend, yes, because it closed 2021 at 13.8, it closed 2022 at 13.3. Yes. And many of us looking into 2023 have been told we're looking into a recession year. We can see inflation is trending at sky highs. Never mind, we're seeing softening now. What's your projection in terms of asset quality from an industry standpoint? What are your expectations?
So I think the beauty of where we are is we are coming behind COVID, yeah? Or the pandemic season. The pandemic season did see a lot of the weaker credits get wiped out. You know, weaker businesses were wiped out. And I think banks took very strong measures to de-risk their books. So the improvement that we are seeing is actually what I would call a leftover from the COVID period, where banks really de-risked. So that is the improvement that we're seeing on the asset book. The second part of it is that obviously because credit books have started to grow again, the denominator is now growing. So therefore, the net or the percentage is coming down as well. So I expect that to continue. In terms of recession, and I think you mentioned a big word, I hold it very strongly that Kenya will not get into a recession. Yeah? There is serious demand that we are seeing out there for commodities. Consumption is still quite high. Yes, people are broke, but consumption is still very high. I mean, during the Christmas period, if you try to get a hotel anywhere in this country, you wouldn't be able to get a hotel. Yeah, it tells you that consumption is high. Now, that comes from something we call revenge spending as well. Revenge spending is when you've gone for a period of time where circumstances have stopped you from spending. Your family, you haven't gone on vacation for 3 years almost. Now when the opening happens, you want to make sure the accumulated savings are spent on really good vacation, pent-up demand, if you may. They're calling it revenge spending these days. You're revenging what COVID stopped you from spending. People haven't bought suits for years. Now they have gone back to work, they need to buy suits. So we're seeing a lot of that revenge spending, and that is helping the economy. But that said, Kenyans will not go into a recession, but we're going to feel like we're in one. Inflation makes you feel like you're in a recession because it makes you feel poorer day after day because prices are going up. So most people would say we're in a recession, whereas actually we are not. Nowhere near technical recession, but we all feel like we're in one.
I see. Interesting take there, John. And the government of the day has indicated that it intends to really place a very firm lead on yields in the fixed income market. And we do know, I mean, banks, especially when risk perception is high, that has been a place where you start cash and you get some good return. How do you see banks positioning themselves as far as this is concerned? Because the president, no less, has told Treasury, don't take anything at above 10%. How do you see that playing?
Well, it would be very good if they could do that, actually, because I think the intention is right. What the president was basically saying is we don't crowd out the private sector. Because when you have good use in the government sector, what we all do is run to lend money to government, yeah, with very good yields. So if he's forcing the yields to come down, that means we will have to go look for better yields in the private sector, lending to real business. So that's a very good idea. The reality is that when you look at, just recently they did the budget statement, yeah? The proposed budget statement, isn't the draft budget statement. And when you read it, they're still going to borrow quite significantly. So the proof is in the pudding. It depends on how they're going to fund that deficit. It's still a significant deficit. Yeah? So for us where we are is that if the government decides not to borrow much from the banking sector, we welcome it because it means we have to find other places to make money, and that means lending to the private sector. And if private sector, which contributes about 80% of our GDP growth, if private sector can move to contribute a lot more than 80% of our GDP growth, then the country will feel very strongly, to feel like it's really growing. So we do welcome that, yeah? And I do hope that he will live to that promise. Obviously, in the short term, that's impossible, given where inflation rates are, given how much money government needs to finance its current expenditure today. That is impossible, but I'm hoping that statement the president has made is one where he's going to push for going forward.
Okay. And speaking about the private sector, John, we're coming off an environment, and by that I mean the COVID environment, where appetite for lending towards certain sectors, understandably so, was a bit guarded. If you look at tourism, if you look at real estate, as we get into 2023, are you seeing the playing field evened out across sectors, or how do you see this unfold?
I think COVID is not really behind us. Yeah, the pandemic part of it, the real fear part of it may be behind us, but it's there'll be episodes of COVID. So I'm not expecting that all the businesses will get to the pre-COVID levels this year. And indeed, what has happened over time is that even hotels, they have retooled. Yeah, most of them, what they have done is reduce the workforce. They're operating at perhaps 70% capacity. But what they're doing, they're charging prices to ensure that they're up 30% in pricing. So most hotels will do very well, not because they're in full capacity, but because the rates have gone up. And that's what you have seen. If you try to book a hotel today, it's perhaps 30-50% over what it was pre-COVID. But it means perhaps 30% of rooms are actually closed, and that's global problem. There's also the other phenomenon that there are hotels that close that will never open because they had huge debts, and hotels are very cyclical. After every 7 years, you need to do a full refurbishment of a hotel. And so if you're planning to refurbish in 2021 and you had COVID in 2020 and you had no money for the whole year and a half, then you don't have the funds to refurbish. So you see hotels that have closed permanently. That's a reality. So I don't think we'll get back to where we were in 2019 as quickly as we'd want to. However, I think other businesses such as manufacturing, agriculture, once the rains come, obviously now we're going through drought. I think those will get very quickly to where we were before because movement and people and services is back. And that is what's going to help the economy to get back to the levels that we had seen before.
Okay. John, a question which many Kenyans have asked is that how are banks viewing the Hustler Fund? Are you viewing them as a symbiotic relationship? Are you competitors? Because as we speak right now, the loan book is something close to 20 billion shillings. It's getting significant. And you also have products along the same corridor, if I could say. How is the association doing that?
Yeah, so one of the things we talk about, and it's actually in our KBA manifesto, is that we must enhance financial inclusion. And if Hustler Fund is what helps us get there, we welcome it fully. And the way I look at Hustler Fund, for me, is that it has widened the financial inclusion net, because financial inclusion is not just about an account. It's about being able to borrow, being able to manage your money, be able to repay a loan. That's financial inclusion. And I think Hustler Fund has expanded that net quite significantly. So we welcome it very much. The second thing is that I talked about credit behavior and the education that goes with it. And I think the Hustler Fund, what it's doing is also, giving a lot of credit behavior education. I think I've seen the minister quite often talk about you must repay your loan, you must do this, recycle your loan, you get bigger rates. So, bigger limits. And that is exactly what we're talking about, even credit risk rating, pricing mechanism. So I think in that respect, we welcome it. What we do hope that the government would do, though, is that it has come with a lot of promise. 500 shillings is not enough to make a lot of change in business lives. So we are waiting for the next release that is coming up soon, which we think it will have significant effect on business. Look, we don't have enough financing in this country. There's room for everybody. And therefore, it's not going to make banking more difficult. It's actually going to make banking perhaps easier for all of us.
Okay. And as we wrap up this conversation, John, for the executives I've been speaking to across banks, one of the trends I noticed coming off COVID is that we saw rapid increase in the lending, but the deposits weren't almost matching up. And I wonder whether from an association level you've observed this, because my question always is, aren't you exerting so much pressure on your deposits? And it raises a question about the sustainability of the lending business.
Yes, so I think in September, you would have observed that phenomenon where deposits were growing not as fast as the lending, and you notice a lot of banks actually went to the repo window of the central bank, or they had other bank lending on their books, quite significant lendings on their books in September. In September, two things were at play. First of all, when you go through a change in government, which we did in August, as you know, usually payments from government stop. Somewhere from June, when the new budget is done, payments to the private sector stop. So liquidity was tight. And that is what you see that phenomenon through that period, all the way up to September. That was one thing that's happened. The second thing that happened is the new government needing to make some daily payments would then get deposits from government-related entities, parastatals and everybody else. So there was a mop-up of funds from those government-related entities. And that money comes from the banks. Thirdly, is even KTDA had paid bonuses during that period. Again, KTDA bonus is a huge amount. Yeah? We're talking about 15 billion. Again, that is money that goes from the banks. And even though it may end up in the banks, most of it will end up on M-Pesa, most of it will end up in cash somewhere in the village, it disappears that way. So those are the phenomena that you saw exerting some pressure on liquidity. I am eager to see the results for end of December. I don't know if you analyzed the central bank returns yet. I expect that to have reversed with government making a bit more payments, with the likes of KTD and other big organizations building up deposits. And of course, as I said, people needing to build for investments as well.
Okay. John, I realize we're running out of time. And maybe just to close this conversation, the last time you and I sat, I remember asking you that sometimes I look at the NCBA share in the market, yes, and I wonder whether this market really priced in the consolidation, yes, between NIC and CBA. Now, last year was a pretty good year for you. And looking back now, do you feel that finally price discovery is happening?
Well, I think I must say I'm very glad with what's happening to our share. One of our big themes last year was about shareholder returns, both from dividend returns, from return on equity, as well as the share price returns. And I think what we have seen, that 56% growth that we saw last year of NCBA shares reflects the fact that the investors are starting to notice that we're executing on strategy exactly what we told them we were going to do, that we are now behind, the merger is now behind us. You see, when you do mergers, 70% of mergers fail globally, right? So in that case, ours has been a phenomenal success. And a lot of investors I speak with, they are saying, in 3 years, you've actually returned profitability higher than the two banks combined that merged, which means the merger has been very, very successful. And I think that is what investors are starting to notice. I am happy that they are noticing. Part of my job is to tell the story of NCBA, so I'm happy about that. And I'm hopeful that that price discovery will continue.
John, thank you so much for your time.
Thank you, Julian. Thank you for your time.
Thank you.